Before we head into this week's market outlook, let me update you on where we are and what I have planned for the week ahead. In the applied series, I'll just write that as AS. In the top-down folder, the contraction video is now up. Also in the applied series, in the futures folder, ES and MES, this is the E-mini and the E-micro on the S&P 500. This video is done. It should be up Monday. I got to wait for IT to actually show up, and they don't show up on the weekends. So these are the futures, equity futures, plus options on futures. So it'll have a section on options on ES and MES, plus I'll introduce some other ones, but really this is the king over here. The NASDAQ one is pretty good, but the others, liquidity and options problems with them. The next one I'll be doing is US Treasury futures. So you start with the two big ones, right? Here's where you get your beta from. Here's where you get your duration from using significant leverage. And also in this one, I do have a strategy for small accounts, which means you have an account that might be $5,000. How can you use futures and options on futures in an account with $5,000? And I'll show you how to use a very low risk, low exposure strategy that can still do quite well over the course of the year. Market outlook. This will be YouTube, YT. I've been asked this quite a bit, is what does this mean? What does that mean? Is there a video explaining what everything means that you may not be sure of? Well, what do you mean when you talk about par rates and real rates and break-even rates and OAS? What does all that mean, and why should I care? You have to start with rates because it is the discount. It is in the numerator. The par rate is the beginning of all, is in the numerator of every discounted cash flow that you do. Is in the denominator of every single discounted cash flow that you do. It affects the present value of all future streams of cash flows. So you really have to start with that and get an idea there. But I'll do a long video. It'll be long because I'll have to explain each thing in the market outlook. But I will put a tutorial up that explains what this is, where I get this, where I find it, how I calculate this number, and what all that means, so that if you're watching the market outlook saying, I don't understand everything, this may help you understand it. Also in the applied series this week, part one of the IPS. I said I would move to that. And this is how you would write up your own or develop your own IPS, which is your portfolio, your investment portfolio strategy. I'll put part one up this week. I don't know how long it's going to be because I don't know how long it's going to take me, but I can't just do it all in one long video because it might be 4 hours long, it might be 8 hours long. I don't know how long it's going to be because there's so many things to talk about. I still have to try to categorize these things as best I can, but I do have enough prepared to get part one up this week. But it is long. There's a lot to think about because it's your business plan. You know, it's how you think about what you're going to do and the rules by which you will operate by. And the rules are meant to keep you out of trouble. When you don't have rules, you're going to get into all sorts of trouble. But if you have rules, once you develop rules, you have a plan, and now you just need to execute your plan. So it is important, if you are going to be putting your money in harm's way, that you want to at least think about what kind of harm you want to put your money, or what kind of harm's way you want to put your money in. Okay, let's head on in. Okay, I am posting this on Super Bowl Sunday. So let me first apologize to the NFL. If you see that your ratings have dropped, it's primarily because this video is competing with the Super Bowl. Sorry about that. Let's begin with rates up here, our par rates. It looks like this is the week that the market finally got the message, higher for longer. And I think that was hammered home quite well by Powell and Neil Kashkari, who actually is talking about this could be for the next 2 years before they're ready to lower rates. 2 years, that's if you don't get a recession, but that this will be the case for 2 years. So when we get to the SPY chart at the end, I will lay out 3 possible scenarios for the market. And there are only 3 scenarios, which end up boiling down to 2 scenarios, because one scenario would lead to it becoming scenario 2. But we'll get to that there. Look at our money market rates. All of them have increased, and capital market rates, all of them have increased significantly. Last week's central bank speaking had the effect of raising rates 25 basis points pretty much across the long end of the curve. So since the beginning of the year, rate cuts in capital market rates are almost disappearing. Give it another week, it may disappear completely. The 2 to 10 yield curve inversion, negative 76 basis points, really hanging out around the 70 to 80 range, 221 days now. And the 3-month to 10-year is, steepening a bit, but still heavily inverted at 105 basis points, is now 109 days. The next FOMC meeting is March 23rd. That is 38 days away. It sounds like a long time away, but that'll clip by quickly. CPI in 2 days. And we get the Fed minutes in 10 days. And this is another one of those do or die days for the market. And it seems like we lurch from one do or die day to the next do or die day. And to try to plan for 6 months ahead, what's your positioning for the year? Positioning for the year, you mean the week. Everything can change on CPI day depending on what that number is. I don't know if the rest of you feel the same way, but I'm getting kind of tired of planning my strategy for up to the next data point and holding back on things I want to do until, I got to see that number because it could change which direction I want to go in. Getting kind of tired of that. A lot of Fed speak going on this week. Monday, Bowman. Tuesday, Logan and Williams. Thursday, Mester twice. Bullard, Cook, and Beaudry. And Friday, Barkin will be barkin'. The Fed balance sheet, no change week over week. Still sitting at $7.922 trillion. Now, this is a little misleading when I say the Fed balance sheet is sitting at $7.922 trillion. It's actually higher than that. This is the system open market account. This is a separate part of the balance sheet, or I should say, a separate listing of the items on the balance sheet that were taken on specifically for the purpose of meeting monetary policy in terms of the quantitative easing that it wanted to do. This is the one that they have to roll off, but they'll always still have assets on their balance sheet. It's just this was the amount taken on over the last decade or so in response to QE. So now that is what's being rolled off. So their balance sheet is actually higher than that, about 500 billion higher than that, but they'll always have some assets on their balance sheet because, much like any business has assets on their balance sheet, they have to have that as well. So it's really just the SOMA that we're looking at here. The other curve inversion here that we've been looking at, this is the 3-month rate 18 months from now, a forward rate minus the current 3-month rate is inverted negative 96 basis points. Steepened quite a bit from 136 basis points. New York Fed effective federal funds rate 4.57. The reverse repo facility, almost no change week over week, up 1.68 billion, but still over that 2 trillion mark. And this is out at 1-day SOFR at 4.55%. March 23rd, the probabilities. Look at what happened week over week. Last week, it was pretty much a sure thing it was going to be 25 basis points. A little bit on the 50, but not much. Look at it now. Almost up to 10% on the 50, 90-10 split at 50 basis points. So we'll see what happens to CPI. And this CPI is not a slam dunk. There is the expectation that, inflation is going away and we should see a lower read. But the items that were creating low reads over the past few months were showing negative negative growth month over month. In other words, we're actually in deflation. Well, there's only so far deflation can go. So let's say you had some categories that were deflating, some that were deflating at a lower rate, some were flat, and then you had some that were expanding. If these start going sideways, well, you lose this negative weighting for the whole category. And if you lose this negative weighting, again, just going sideways, some of these that just start to go sideways, you will get a higher read on CPI because you won't have the negative weightings to offset the positive weightings. You'll have zero weightings and nothing but positive weightings left. So CPI is not a slam dunk. At some point, deflation stops. And even if the prices don't reinflate, it starts to go sideways. The month-over-month change becomes zero, not negative, so that your headline number ends up being a higher number. So if you see CPI come in a little bit hotter, it might not be because inflation is increasing. It may just simply be that deflation has stopped. And that might be a little bit difficult to read. However, the market is going to respond to the bigger numbers, and maybe after digging through the rest of the numbers, there might be a different reaction. But it's not a guaranteed that it's going to come in lighter. It may, but it's not. Just keep in mind, deflation can only go on for so long before companies just say, "Well, that's it. I got no room left to cut prices. This is as far as I can go." And there was some talk about the used car prices over the last month increasing. We know that gasoline prices have increased. That finds its way into transportation, and transportation is a weighting outside of the energy component. It is a weighting in a lot of the other components for CPI because you got to get stuff to market, right? For June, the weightings on the terminal, I wouldn't say terminal rate, but the rate that we would expect in June, because we think they'll be done cutting rates by then. So we can say that it is the terminal rate that they would hit in this rate hiking cycle. All shifted downwards here. The 5.75 has now 3.4% probability. It was a 0.1, almost non-existent. But 5% was sitting at 29. It's dropped to just a little under 10%, and the weighting is being pushed to the 525 and the 550. Big jump in the 550, 13.8 up to 38%. Even a drop at the 525 from 57 down to 48. So we are thinking, well, maybe 525 to 550. Maybe there's two more 25s to go and not just one more 25 to go. Neil Kashkari on CNBC said he had a terminal rate of 5.4 and he's still comfortable with that 5.4, and I think he was talking more about an effective federal funds rate, which puts the range 525 to 550. This here, when I say 5%, that's the upper part of the range, 475 to 5 to 525. This is the upper part of the range. You got more weight moving to the 550. This is interesting. Because when we get to the Fed funds rate, the Fed funds futures market, we'll see that market finally got it as well, that there are going to be no rate cuts and it will be higher for longer. So it's taken out some of the rate cuts it saw for the end of the year. So if you are going to have higher for longer, as Kashkari is suggesting up to 2 years. And Powell was quite forceful in saying, none of us anticipate any rate cuts this year at all, and we are going higher. And once they get there, no matter what the data is, no one's anticipating any rate cuts. The fixed income market, both in the money market, in the overnight market, and in the capital market, seem to be getting it. The equity market hasn't got it yet. Because if you're going to have those rates higher for longer, let's say 2 years, the cost of capital has to change. The cost of capital, any incremental new capital, has to be higher. And if that cost of capital is higher, then fewer projects will be started because they'll have to be significantly net present value positive. In other words, significant cash flows, because you're no longer discounting them at 2, 3, 4%. You've got to be discounting, especially risky cash flows. You're going to be discounting them at least. Well, now what are we thinking about? 500 basis points higher than you did in 2020 and 2021. So that's going to put a lot of projects net present value negative, which means they won't be done. Investment will be significantly lower, which means growth will be lower. The market, the equity market, is not pricing in that higher cost of capital, lower growth scenario right now. Our real rates have moved up, not as much as nominal rates have moved up though, which means our inflation break-evens are moving higher. And this is in line with Friday's consumer confidence numbers that we saw, not so much for the long-term inflation expectation, but for the current period expectation. That actually increased. Look at the curve for Fed funds futures. Last week it bottomed out in July at 94.97, implying a rate of 5.03. I'm going to stick it in the 5.5 to 5.25 range. 15 basis points, we're at 94.82, 5.18, which puts it firmly in the 5 to 5.25 range. And you can see that September is just as low, July is just as low, but we moved from July to August now, so it is pushing out further, and 15 basis points lower at the August read. If we go out to December, this is quite big as well. We're at 4.975. Last week was 95.025. We're at 95.025, which is 4.975. Last week was 95.29. So 4.71. So December moved up, the rate in the index moved up 26.5 basis points. That's a full rate cut taken out. It is still suggesting that from August to December, there is still a 20.5 basis point difference between the two. So there's still a little bit of hope left in December. And I think as we move forward here, this curve will continue to do this kind of thing, to drop a little lower and flatten out as it starts to take the Fed seriously on this one. So there are, I'm going to lay out three scenarios here. I said I'd do it when we get to the equity market screen, but I'll do it now. Three possible scenarios. And I think that this curve over here is a combination of scenario 1 and 2, but is certainly not 3. 3 is recession. If we have a recession, then this whole curve is going to shift upwards quite dramatically. And previous, I had sort of looked at what the curve was doing in December and saying that it's wrong, that we're not going to get 2 cuts this year. We're either going to get no cuts or a lot of cuts. You're going to get no cuts because it'll be higher for longer, or you'll have a recession. So there was a comment saying, could the long end of the curve, could the, not long end, but the long dated end, could the December rate be pricing in a weighting of those who think there is recession versus no cuts? And it seemed reasonable. Well, I think that the market is not pricing in any recession at this point because of the way the curve is sort of dropping and flattening out, not just in May, June, July, but now August, and starting to flatten itself out on the long end. It's pricing in a higher for longer. So, we could have a couple of things, because I heard last week, the idea of no landing. Never mind soft landing or hard landing, we're going to have a no landing. Which means we're just going to keep on doing what we're doing right now. So I'll call that a growth. And number 2, I'll call low growth. And this is negative growth. So if we have positive growth, you're going to have, upward pressure on capacity. Upward pressure on, and we're at capacity on labor right now. So inflation is just going to show up again sooner, which means rates even higher for even longer until you push growth into the low growth scenario. This is the only pathway you have, is low growth, and you have to stay within this pathway. If you think of this as a river, you get too far to this shore, you're going to see inflation. You get too far to this shore, you're going to see recession. So this path right here is what I think Kashkari has right. It could be a 2-year process, meaning that we are going to have to get used to a Fed funds rate over 5% for some 2 years or so. I don't know if you're going to maintain an inverted yield curve for that long, but it is going to change the cost of capital, and that's going to have to be reflected in equity prices. If we think about discounted cash flow, which is the most common way to arrive at a value. If you're valuing stocks, the value of a stock is equal to the sum of all the future cash flows discounted at some cost of capital. Well, then the valuations have to adjust upwards. I think that analysts haven't adjusted their weighted average cost of capital yet, thinking that, well, let's use a long-term weighted average cost of capital because these rate hikes are transitory. Well, if they're going to be there for 2 years, you're going to have to adjust the cost of capital. And if you assume the same cash flows that you were assuming before, but you just increase your cost of capital, you're going to lower your valuations. You could say that, well, if we are in this scenario here, present values of equities are probably too high. If we are going to have a recession, well, then earnings are too high, which is your numerator. So scenario 2, your denominator is too low. Scenario 3, your numerator is too high. And scenario 1, your rates are not high enough. They'll keep going higher. I don't know how we get out of this in a nice way unless inflation really just zooms right into deflation over the next 2 or 3 months, and the Fed becomes really worried about deflation. And if it does that, well, revenues are going to have to drop because, well, deflation is a drop in prices, and those drops in prices are what businesses charge. And if that's what's going on, then revenues have to drop. And if you have deflation with sticky wages, you're going to have margin compression, which means equity prices are too high. So in scenario 1, equity prices, rates are too low. They'll have to increase to push you back down to a low growth environment, which means that any bull run we have in the market can be sold. Number 2, the cost of capital is too low. It has to be adjusted up, which means equity prices have to drop. In recession, equity prices would have to drop because the numerator would drop. Under every scenario, any rally can be sold. So I'm fairly comfortable with my short position right now. The one year forward minus the current 1 year is inverted 78 basis points. Last week it was 98 basis points. So we are seeing, other than the 2 to 10, when we look at the money market inversions, which this is one, the 3-month rate, 18 months forward minus the current 3-month rate, and the 10-year, the capital market to the money market inversion, the 10-year to the 3-month, are all steepening. December 23 to December 24, looking into 2024, we're seeing here that the market seems to want to price in a 20 basis point differential between where they see August and where they see December. And if you go from December, this over here, to the very next December, I'm using 1 month SOFR to get this done. 4.89 minus 3.38 is 151 basis point 151 basis points cuts through 2024. If we believe Kashkari, and you don't get a recession, then this number is more likely to be 0. So that curve has done this for the 1 month SOFR. That has all got to flatten out if we don't get a recession. If we do get a recession, this will shoot up like this very quickly. TLT. Finally, some action on TLT, so I can do something. Down 3.3% for the week. The SPY is down 1.46%. Some implied volatility has returned as well. If we look at the percentiles, the last 13-week percentiles at 15%, up from 0. 26-week at 10%, up from 0, and 52, well, because you have a longer time period here, at 5% instead of 2, but, this is at least showing that there is some IV coming back in. I sold the March 104 puts for 217 because I still need to recover some of my long, the money I spent on the long position, of which is all the way to January 2024. I got what, 11 months to get that done. So there's no real rush. I'm going to wait until the market comes to me so that I can get what I want. So I sold the March 104 puts for 217. This is more of a CPI play. I seem to think that with the momentum in CPI over the last couple of months, I'd place a higher probability on the numbers pleasing the market than displeasing the market. And if the numbers please the market, the rate hikes you saw the market do in the capital markets last week, I think they could undo them, which means that prices up, yields down. And if that is the case, then you could have a nice bounce back in TLT. And I'm looking to grab a quick buck off this one. So if it goes from 217 to 117, I would probably cover those puts. Just grab a quick buck. If there is a rally and it looks weak, I'll grab whatever I can out of it. I'm just looking to offset some of the cost I still have left. I'm trying to get those for free. I'd like to get them for free by June or July. So it'd be nice to grab a buck off of that one. Moving to credit spreads, OAS. I'll just check the columns that are investment grade, and you can see almost no move in investment grade yields. And this is as of Thursday. We don't have Friday's number, won't have that till Monday. High yield has shown some spread widening, but triple C is the lowest spread widening of them all, and that's the lowest rated in high yield. Spreads increased 6 basis points. Comparing yields on corporate bonds to treasury yields, 6-month is 4.89, the 1 year is 4.89 as well. The 1 to 3 year investment grade bucket is 5.22, only 31 basis points higher than a 1 year treasury. And there was a comment last week about there being a better tax advantage behind the treasury versus the investment grade, that at that rate it was still better to take the treasury. And I thought that, well, all interest is taxable. And I don't know if this is true. I mean, I don't know. I'm not questioning the person's answer, but that there is no state tax on interest earned on treasuries. I don't know. Maybe that is state by state, or maybe that's countrywide. I don't know. But if that is true, then yeah, it's on an after-tax basis. That would make a 1 year treasury probably preferable, or maybe even indifferent to the 1 to 3 year investment grade if the savings in taxes account for that 31 basis points. That would say that you can go and take on credit risk for no extra after-tax benefit, or even for a lower after-tax benefit, which seems, dumb. Looking at mortgage rates, 30-year fixed rate mortgage, and again, this is as of Thursday, 6.12, increased by 3 basis points. So if we look at the 10-year as of Thursday, it had increased 14 basis points. If the mortgage rate increased 3, that means the spread between them has decreased by 11, which is good for mortgage-backed securities. Mortgage apps, again, showing life, right? 7.4% increase. Refis up almost 18%. Purchases up. The purchase index up 3%. Wednesday, we get the National Association of Home Builders Housing Market Index. This is a diffusion index. Anything less than 50 is contraction, and it has been less than 50 for quite some time. I don't think that's a shock. Then Thursday, we'll get building permits for January. That is a leading indicator. LAD, there we go. And housing starts for January as well. If we look at our forward curve is starting to look a little bit more realistic for the 1 year forward. But for the 1 year to the 1 year forward is a drop of 78 basis points. The 1 year that's 2 years forward is another 53 basis points, which is 131 basis points lower. If we think that you have this forward curve doing this, because we have the inversion of the yield curve, you're going to have a forward curve that lies below that, so the forward curve would be downward sloping as well. If we think higher for longer, then this 1 year forward is probably too low. You got to take out the 78 basis points if you don't get a recession. If you're not in the recession camp, you got to flatten this. You got to flatten out this forward curve. And if you flatten out that forward curve, these yields are too low. So these corporate bonds are overpriced if you believe that the forward curve is more horizontal and not downward sloping. Look at some economic data here from the previous week. Initial jobless claims came in at 196. When we get it, it is for the week before. That's why it says for the week ending February 4th, which is then reported the week after. 196. These numbers are low. 183. 4-week moving average below 200,000. 189, 250. Those for it to signal that the job market is getting close to zero, you need 275 to 300 per week to get to that point, and we are not seeing that. Almost every day in January, when I've gotten up and opened up the news feed, I see layoff announcements. Every single day I've seen layoff announcements, but there is a law about layoffs, about mass layoffs, is that you have to give 60 days notice before you actually do it. You have to announce it 60 days ahead of time. So the January announcements aren't going to show up until March. So we've got about another month to 5 weeks perhaps, and if they are going to show up, that's when they'll start showing up in initial claims. Because that's when the layoffs, the actual departures will start happening. Michigan consumer sentiment. This was a sort of a mixed result here. 66.4 up from 64.9. So that was actually good. Sentiment is improving, but from a low level. The 5-year inflation expectation 2.9 and 2.9, and listen, this is just a wild guess. Nobody knows, especially a consumer, to say, hey, what do you think the 5-year inflation consensus will be? What they're trying to capture here is the expectation that if this came in higher, then they would start saying, since the expectation is coming in higher, that will start to build itself into wages now, that expectation will start to show up in the way that they make decisions and how much money they ask for. And it's sitting at 2.9, probably higher than they want, but it's not increasing. This is, where is it? This is the one that caused a little bit of grief. The inflation expectation, 3.9 up to 4.2. That is the one that caused some grief there. Current conditions had a big jump, 68.4 to 72.6. Consumer credit, got that earlier in the week, increased by 11.56 billion, and I will show you how to find that number and look at the trend in that. But the forecast was for 25 billion. The previous was almost 28. We thought, well, it'll increase for December by 25. It's only 11.56. We now have all the data from the fourth quarter. So next week, I think on the 15th, is the household and credit report that's released quarterly by the New York Fed, which goes into detail about each of the different loan segments, the credit quality of all of the different borrowers in each of the segments, where the default rates are, where the delinquency rates are. So it goes into a lot of detail. So that's a big report. But let's look at where we get consumer credit change. This is released by the Federal Reserve, and it is called just that, consumer credit, G.19. Let's look at our first table. The first 3 lines gives us percentages, the percentage change, total percentage change, and then you have revolving and non-revolving. So revolving is like a credit card balance, non-revolving is like a car loan. Then your total flow for revolving and non-revolving, and your total outstanding. And if we look at the difference between November and December, that is the number we saw on the previous screen for the increase of 11 billion between these two numbers here. And you can see the increase in revolving and non-revolving, but you do have the percentages up here. 2.9 is rather low when you look at the percentage changes over, let's say, 2021, the last Q4, Q1. This is 2022, Q2, Q3, Q4, and then Q4 broken down into October, November, and December. You can get it in terms, well, there's nothing much in this table because they don't give you the breakdown in terms of car loans, credit card plans. This is consumer credit outstanding. So we just take the total amount of consumer credit. This does not include housing, by the way. So housing adds probably another 12.5 to 13 billion to this. So this does not include housing. Who's holding the debt by major holders? Depository institutions, finance companies, credit unions, federal government, and major types of credit by holders. This breaks it down into revolving and non-revolving. This is just the total outstanding. This is the total revolving outstanding, the total non-revolving outstanding. So there's some high-level information here, but the New York Fed's report next week goes into a lot more detail. Some interesting moves in currency markets in the last week. We'll start with the top chart, which is the peso, the U.S. against the peso. This right here is the U.S. getting stronger, the peso getting weaker. So it peaked over 19, and I went long the peso, which means I sold the pair spot and covered down here because you had a central bank meeting ahead, and I just didn't want to sit through that risk. I just thought, wow, I was doing this for a quick trade. That was it. They had a rate hike to 11%, so they're sitting down around 18.67 right now. If there is a recession, a global recession, the peso will not perform well in a global recession. It will shoot straight up. But I would be willing at this point to buy the peso anywhere in the 19s. Of course, that is the what I would do. You have to answer the question of why as well before you do the what. Why did it get to the 19s? And if it is something bigger, a bigger trend, like we're starting to see something globally heading to a recession, then I would not, because it would not perform well in a recession. Let's look at the yen. There was some discussion late last week. The replacement for Kuroda would be very dovish. So the the yen did not perform well in that on that idea. And I guess that person said, no, thank you. I don't want this job. So they appointed someone else, and the market initially liked that idea, but then later throughout the day they thought, well, maybe we don't like that idea. Because he had made a statement saying that he believed that monetary policy as it stood was appropriate, and they thought he would be more hawkish. So the new Bank of Japan governor was announced here. Spot, I am long the yen versus the US, you can see down here, and I am long the yen versus the Canadian as well. Both of these spots pay in yen. So when I close them out, I just have a growing yen balance in my account. The unfortunate thing about the yen trade is you have negative carry on both sides. Because if you are long the yen, short the US, if you have US dollars in your account, your US dollar balance decreases. Well, there's an interest rate you get paid on cash. Same with the Canadian. It decreases, so you lose the interest rate on both the CAD and the US. And you think, yeah, but you get the interest rate on the yen, right? Well, the yen has a negative 0.1% rate. So you actually have to pay yen back to the Bank of Japan. I'm not kidding you. They take money out, you lose yen. So you have a very slow leak on your yen position. So being long the spot, you got negative carry on both sides, although it's small. So you're really hoping that there is going to be a move, but I'm not going to hold this position very long. If it doesn't look like if it's going to go anywhere in the next 4 to 6 weeks, then I'll probably close it. Let's look at the Canadian dollar. The Canadian dollar is just not weakening much past 134.5 to the US dollar. This was the jobs report, and you can see down here how strong jobs were. Employment change, 150,000. The expectation was for 15. That is 10 times higher. And almost every data point was good. The unemployment rate came in at 5% instead of 5.1. Average hourly wages year over year came in at 4.5. The previous read was reduced to 4.7%. I said reduced or revised upwards to 4.7%. This came in at 4.5. Full-time change added 121,000, part-time 29,000. So they primarily coming from full-time positions. Participation rate, nice big jump in the participation rate, 65.4 to 65.7. And the Bank of Canada has signaled that it is on hold. So the the observation that it won't weaken past 134.5, even though they signaled that they're on hold, to me suggests that the Canadian probably has some strength behind it. So I am long the Canadian. You see this little red line on the chart, meaning that I'm short. I'm short the pair, which means I'm short the U.S. This is the U.S. getting stronger. This is the U.S. getting weaker relative to the Canadian. So I am in the money on this trade. Nice thing about this is it does offer a partial hedge against the U.S. position that I have. I think I'm over-hedged at this point. Says elevated debt. Meldrum says elevated debt might make households more sensitive to rate hikes. And this is why he stopped. And this is a rather interesting stance to take. It's plausible that higher interest rates could slow the economy faster than in the past. And Canadian households, if we look at household debt to disposable income, I don't know that there is another country in advanced economies that has household debt higher than what Canada has right now. Even removing mortgage debt, it's still an elevated level of debt. So that he's probably right that rate hikes could have a more damaging effect on the economy than in previous cycles, purely because of the level of debt involved. So he signaled that he is on pause or on hold now because of that. And I thought, well, if you're on hold, the U.S. is clearly signaling higher for longer and that they are going to go higher, that for the Canadian to show this kind of strength, that it just won't weaken past 134.5, 134.6. And it's tried a number of times, tested that a number of times, and you have this sort of trend going on. Given the strength of this jobs report, it could show further strength. You could get back to the 132.5 that we had down here. So we're sitting at 133.4. So maybe another 100 pips down. I'd probably cover at around 132.5 if it decided to retest there. I'm still troubled by the name TIFF. So I did some searching. I thought, well, let me find out what the source of the name is. And I think this is from parenting.com or something. Let me try to find a place where this shows up here. The mark of God is what it means. The medieval English form of the Greek word theophania, which composes, terrible writing here, which composed of theos, means God, and tha, and ein, my Greek is bad, means to appear, God to appear, the mark of God. The link right below was Baby Names UK, so I decided to have a look at that one because you never just look at one source to see if the other source verifies it. Meaning of TIFF. Name TIFF in the Greek origin means the appearance of God for mankind. That is a bold name to give someone. It's like, hey, the appearance of God. Let's give them that name. Name TIFF is of Greek origin and is a girl name. People with name TIFF are usually Christianity by religion, so I am now even more troubled by the name TIFF. Some bad news for Canada. If you're Canadian, you probably have been reflecting on this all day Friday. I know I was at the grocery store the other day, and the shelf where I usually go to get my maple syrup was empty. I'm not kidding you. It was empty, cleared out. Climate change is threatening the maple syrup industry. Syrup producers are recording declining yields due to increasing global temperatures, which are leading to more invasive pets, sap that is less sugary, and shorter harvesting periods than the normal 4 to 6 week season. And I don't think it is much of a stretch to say that you can walk into any Canadian home and you'll find maple syrup in the fridge. I think on a per capita basis, private ownership of maple syrup on a per capita basis is probably higher than private gun ownership per capita is in the US. And I believe it is in our Constitution, the right to bear maple syrup. So this is a big deal for Canadians. By the way, if you want to bring your life to a new level, for your tea and your coffee, get rid of sugar. Get rid of sugar altogether. In your tea, put honey. Sugar releases in your body immediately. The sugar and honey releases slowly over time, so you don't get that sugar rush and then that crash. So it's a better form of sugar. It's a more natural form of sugar as well. In your coffee, put 1 teaspoon of maple syrup, and you will thank me later. It will elevate your life to a new level altogether. Get rid of the sugar in your coffee and just put 1 teaspoon of maple syrup. Get the amber maple syrup. It's the best one for that if you can find it. And as I said, you will thank me later. So have a look at SPY now. Forward 4-quarter EPS dropped again down to 220.30. Last week it was 221.01. It's down another 71 cents. And SPX closed at 490.46, which gives us a multiple of 18.57. There were a couple of questions about whether or not we could get the 220 broken down by quarter. If we could see for 2023 how much of that comes from each of the quarters, and you can on the first tab of the spreadsheet. Link is in the description box, and I'll show you on the next screen where to find all this stuff. Lines 129 to 132, column C, the sum of those 4 quarters adds to the 220 that you see over here. And then on the next tab, it breaks down that 220.30 by quarter by sector. So you can see how much each sector is expected to contribute per quarter. The June ES contracts that I'm short ended at 41.36. My average is 41.20. I'm rounding to 41.20. It's like 41.22. I'm just rounding to 41.20 because it's just easy to remember. Which says I'm about 16 points underwater per contract. But this is a future price, not a current price. So I look at the current price, 40.90. I got 41.20. I'm actually 30 points in the money based on where it sits right now, because this I have positive carry because I'm short of 45.54. This decays linearly. The interest rate component decays linearly with time. So every day the same amount comes out of the carry because of interest. That's linear. The dividends decay almost linearly, depending on if they cluster in certain periods of time. But if we assume that dividends occur sort of on a uniform basis throughout the year, then we could say it declines almost linearly with dividends, but it does decline linearly with changes in days because of the interest rate component. I did sell 50% of the short position I have using 40-50 puts at 122. If it is put to me, it gets me down to around 39. I'll just round it off to 39.30. And I think right now fair value for the index is 38.50 to 39.50. So that puts a 39.30 kind of in that range. So if they are put to me, they'd put to me at 40.50, but I got 122, which puts me at around 39.30 as my average exit, my average cover, which I probably would do in there anyways. So I'm comfortable with that position. Let's look at the earnings yield on this market. One divided by the multiple, 5.39%. Compare that to the 6-month T-bill at 4.89, 50 basis point difference. So you could be in a T-bill for the next 6 months, or you could be in the market for the next 6 months. And the expected excess return, whenever we talk about excess return, it's in excess of the risk-free rate that we could get. The expected excess return is 50 basis points. that is the middle of a distribution. Obviously, you'll have some kind of distribution. It could be greater, it could be less, but you're moving away from a point, which is 4.89. You're going to get 4.89 because this is a discount, and it simply matures at par. There is no reinvestment risk. You're going to get it. That's pretty much a guaranteed. Or you could reach for another 50 basis points with a lot of uncertainty. And whether or not you'll get the extra, or you'll get more than the extra 50 basis points. There's a 50% probability, basically, that you will get less than 4.89. Is 50 basis points of excess return enough to compensate you for taking that risk for the next 6 months? Seems that the market is a little overpriced there. If we look at it on the 1 to 3 year investment grade, that's paying 5.22. Default risk there is almost non-existent. But there is some risk in the 5.22. So if we think about that as part of the middle of a distribution, the distribution is really tight. Really tight. Not a lot of uncertainty. The uncertainty comes in the reinvestment risk. So when you get your coupon, what rate can you reinvest the coupon at? Such that if we think, well, if I put $1,000 into an account that holds this bond and I come back at the end of a year or 2 years to see what I've got, well, you have the cash that's going to be reinvested. Maybe you'll reinvest all the cash at a 6-month rate. Maybe it'll be higher. Maybe it'll be lower. You don't know. But that'll be the only difference in the 5.22 that you would actually realize is through reinvestment risk. Or you could reach for another 17 basis points and take on this whole distribution. Think about that. You can reach for another 17 basis points based on where the market is priced today. And I, for one, think that the IGs are not reflecting a more flat forward curve as opposed to a downward sloping curve. I think it is overvalued. I think this yield should actually be higher. And if this yield is higher, then this yield would have to be higher. For this to be higher, this multiple has to be lower. So by almost every measure we have here, this equity market is overvalued. And being that we've had declining earnings every week, the forward forecast has been dropping. And this is a bottom-up estimate. It's been dropping. And the market still wants to trade at 18.5 times earnings, more of a liquidity multiple, assuming that liquidity is going to come back in, that all of this is going to end and liquidity will come in. The bond market and the money market and the Fed funds futures market has been getting the message higher for longer. We've seen it this week. They're moving in that direction, saying, all right, we give up, higher for longer. The equity market just hasn't gotten there yet. I think it will. 18 times at 396 and 17 times puts it at 375. Lots of resistance before you get to 400. There's a lot of resistance. And then before you get to 390, you got to get past the 50 and the 200 before you get to 390. So it appears technically very well supported. We've had 340 companies report. And earnings have been dropping since they've been reporting, and we're still at 408. You've got maybe 160, 170 companies left to go. I don't know that they'll move the needle. I mean, the big names have come out. There's some big names coming out still, but the weighting of the big names have come out, and we haven't really moved the needle much past 408 that we might be supported at 400. So technically, we look supported. Earnings, I don't know, are going to be negative enough to really move this if they come in the sort of the negative pace that they've been coming in, which isn't being a complete washout, but it's certainly nothing to celebrate. I don't know that can get us past 400, which means if we're looking for downside below 400, we got to look to the economic data. The most obvious one that can do that, well, two that could probably get it done. Number one is going to be the CPI. If that comes in without a drop, even if it just comes in, at the same level it was last month, showing, the drops in inflation are done, it's going to be at this elevated level for a while. That could do it. A hot reading would definitely do it. And Fed speak is the only other variable that could get it done is, keep pounding away that higher for longer. And if the bond markets, the fixed income markets, continue to price that in. And we see that the Fed funds futures curve is flattening into December and reflecting, a terminal rate of 5.25 to 5.5. The equity market is going to have to adjust its cost of capital. But I'm not looking to the earnings to get us past 400. The technicals are strong at the 400 and the 390. So, yeah, it's the economic data. So if CPI comes in helpful, the equity market could rally. I would probably look to increase the puts that I've sold to take advantage of what we'll see down here is higher implied volatility. And I think if I see the June contract anywhere between, up here, we're at 41.36. If I see it anywhere between 42.25 to 42.50, I would be shorting more at that point. Implied volatility has increased 32% on the 13-week versus 3% last week, so that was a nice jump. We could see it here. The last reading on implied volatility, the closing on Friday, was 18.7 week over week, 16.2 up to 18.7. Really increased implied volatility. I'm hoping that Tuesday's CPI is a number that is ambiguous. In other words, that there's something in there for the bears and there's something in there for the bulls. That's what I'm hoping, because you'll get even more volatility. This will spike more, which will make selling the puts that much more lucrative, because the premium will have increased. A little bit of a story for the bulls here. Friday's put call ratio was 1.35. The open interest put call ratio is 2.11, down from 2.27. But we do have options expiration this week, and it is common for, depending on the strategy that you're using, it is common to close out your option strategies the week before expiration, simply because you don't want the gamma risk. So this could just reflect, being that there were more puts probably sold, it could probably reflect just a reduction in positioning ahead of options expiration week. So my thinking on the index is what I had expressed earlier is I see three possible outcomes, and I had given you this, where you have growth, you have low growth, and you have negative growth. And I think there's a very fine, a narrow channel in here, that if you start pushing up towards growth, you're going to get inflation, which means interest rates are going to have to go higher to get growth back down to avoid inflation, unless you can conceive of higher growth without inflation. But we are in a hard capacity constraint labor market right now, with a very sharply upward sloping labor supply curve, almost vertical. So it's hard to conceive of how you could get significant growth without wage inflation, unless that growth comes with significant investments in automation such that you don't need people. That is I think, very, very narrow pathway to follow. And let's keep in mind that it's not just the U.S. we have to think about. It's other parts of the world. Central banks have been across last week, I think three or four, had raised interest rates as well. Norway, Mexico, I think there were two others, and they don't come to mind right now. So it's not just the U.S., it's global. Credit is tightening in terms of its the availability. Interest rates going up globally. That's going to affect demand globally, and 40% of the S&P revenues are global revenues. If we have low growth, then again the multiple I think is simply too high to reflect that level of growth. And if we have recession, then earnings are too high. Also, as I said before, if you have low growth, your cost of capital is going to have to be adjusted upwards. So your denominator is going to have to increase, which increases valuations. Under this scenario, your numerator has to decrease, which decreases valuations. And under this situation, interest rates are higher, which means, of course, your cost of capital has to go higher as well. So I just can't see right now why we would want to go to 19 times earnings, 19.5, 20 times earnings, I can't see it, and I don't think it holds. So that and I want to be clear on this, I am comfortable being short beta under this scenario right now. I'm comfortable being short beta because I know if I'm wrong, I'm not looking at hundreds of points of upside. I just can't see hundreds of points, and I can work my way out of trouble. Whereas maybe you might not know how to work your way out of trouble. So I'm not putting this out there as investment advice, just to show you the thinking that I go through to get to the position that I want, that under each of these scenarios, I can only get to a condition of lower valuations. I can't see where I would be willing to pay more for earnings, given that central banks are not going to provide liquidity to support those higher multiples like they did in the past. Those higher multiples came from a lot of liquidity being supplied, from squeezing yield out of the bond market and pushing those people somewhere. Well, the bond market has yield now. I mean, when you look at a 6-month return of 4.89%, you haven't seen that for, 15, 20 years. 4.89%, and you can get an extra 50 basis points on that by stepping into equities. Or you can get another 17 basis points by stepping down the capital stack from investment grade bonds that pretty much are going to pay you to equities which have a 50% probability of having an excess return less than 17 basis points. It's just not there in terms of valuation given what I can get on the bond side. So this is how I get to the position, or how I feel. What I want to do is, it's step by step. I look at rates, I look at the economic conditions we have, I look at what the central bank wants to do, I look at where earnings have been going, I put the whole picture together, all the little pieces together, and I just can't see elevation above, maybe we can get to 42 on some euphoria, maybe 43 on ridiculous euphoria, but I would probably be selling long positions and adding to my short position significantly if we got there, which, maybe a small part of me hopes we get there. Every year there's always one position that makes your year. This could be my position that makes the year. Okay, let's have a look at the spreadsheet that you can download from S&P Global. Column D, line 92, row 92, there is your estimate, the current estimate that you have for 2023. That's the expectation is 220.30. You can see how it's come down. At the end of March, it was 246. We've come down all the way to 220. And if you scroll down a little bit more, you get to lines 129 to 132 under column C. This is the operating earnings per share bottom up. There is for the end of the quarter, March 23, June, September, and December. Here are your four broken down by quarter, and you can verify that these add up to this number here. If you want even more detail, the second tab is sector EPS. Here is the index name, the S&P 500, along with all of the sectors. It gives you everything, 2013, Q1, Q2, Q3, Q4, so you can do a lot of analysis on past earnings. But if you scroll all the way out, there you are with 2023 Q1, Q2, Q3, Q4. The E means an estimate. These are the numbers we saw on the previous screen for Q1 through Q4 and broken down by sector. So the sum of these sectors adds up to the quarter. The 4 quarters add up to the 220.30 for the year, and it's broken down per quarter. And if you want to see how close the numbers have come in previous quarters, what you can do is you can scroll down here, and these are the actual numbers that have come out. So this column will be filled in once all the components have reported for Q4 of 2022, which that is the reporting going on now, is for Q4 of 2022. You won't get this column filled in, the actuals filled in, till sometime late May, because earnings season starts in April for Q1 and runs as late as sometimes into June You don't get these numbers filled in until all the components report, and then you can compare it to what the estimate was that we had up here. But you can go back and do an analysis of each of these quarters. There's 2022 Q3. Those were the estimates. These were the actuals. So we could see 44.41. The estimate going in was 50.35. That's a significant drop, right? And then you can see exactly what sectors were the poorer performing ones. Click on the last tab, forward schedule. You have the companies that are reporting. You have your economic calendar for the week. This is the big one, CPI. Retail sales is the next day. We've had just ugly retail sales. This is for January. November, lots of negative signs. December, lots of negative signs. And then this will give us a number for January. Industrial production, business inventories, the housing market index, housing starts and permits. I noted that when we talked about housing. PPI as well. Not as important as CPI, but still getting attention. And then on Friday, you have the leading economic indicators. And it is in recession territory. If it comes in negative again, that is not good. So let's see what that comes in. But it all starts Tuesday morning at 8:30. You could say the market really doesn't open till Tuesday at 8:30, because Monday is just going to be small positioning ahead of that number. I don't think anyone's going to commit to anything significant unless something happens between the time that I'm doing this and the time the market opens on Monday in another part of the world that is significant. The U.S. market on Monday, I think, will be a snoozer. As we wait for CPI at 8:30. Let's look at what's reporting. And what I've done is I've highlighted consumer discretionary and information technology because they've been more to the disappointing side, and looking at materials and industrials as well because their guidance is going to be extremely important. So we can see exactly where they're reporting in IT and in materials and industrials if you want to follow that. So you do have some big companies reporting. There's Coca-Cola, consumer staples, and this is the sub-industry that you can see down here if you're interested in certain sub-industries. There's a healthcare REIT. I think there's quite a few REITs that are reporting this week. A residential REIT, hotel and resort REIT, specialized REIT. REITs tend to concentrate more in once you get to like the 5th week, 6th week, 7th week in the earnings season, you tend to get a lot more REITs that report. I know all of mine, none of them report in January. I think the earliest one reporting starts next week, the earliest one, and it goes into the end of February. So anyways, there is your earnings calendar it's in the last tab of the spreadsheet, and there is your economic calendar. And as I said, if you want the sector, the EPS broken, the forecast broken down by sector, maybe you're playing just a particular sector in the index and you're looking at that. And if you want it broken down by quarter, you find it there. Anyways, it's Super Bowl Sunday. I don't anticipate that I'm going to get a lot of views today. I think this is more of a after the Super Bowl or non-American thing. Maybe for non-American viewers, you might be watching this, but I don't know too much about my North American viewers if they're going to even be looking at this today. So I'll keep it short, and we will end it there.